Okay, now the next is MCQ number 22. It's on capital gain. It is on claiming exemption under section 54 and 54F together. Previous year 22-23, Mr. A has transferred the following assets. He has transferred two assets, 1 and 2, residential house property and jewelry. Residential house property, full value of sale consideration is 8 crore and index cost of acquisition is 6 crore, resulting into LTCG of 2 crore. Transferred on 25th November 22. Jewelry is transferred for 3 crore and index cost of acquisition is 2 crore. Therefore, LTCG would be 1 crore. Transferred on 5th January 23. Both of them are transferred in the same year. Further, now Mr. A bought a new residential house property on 1st April 2021 for rupees 1 crore. Now, acquiring a new residential house property against sale of residential house property will make him eligible to claim exemption under section 54, or buying a new house against jewelry will make him eligible to claim exemption under section 54F. However, for 54 or 54F, what is the time limit to acquire the new asset? The time limit to acquire the new asset is 1 year before or 2 years after the date of transfer. 1 year before or 2 years after. So when is the first asset transferred out of these two? First building is transferred on 25th November 22. 25th November 22 minus 1 year back, it must have been 26th November 2021. And 1 year before 5th January 2023 would have been 4th January 2022. And when is this asset acquired? This new house property is acquired on 1st April 2021. That means it is acquired before 26th November 21 or before 4th January 22. That means acquired more than 1 year prior. It is acquired much before 1 year before the date of transfer. Therefore, this particular asset is not eligible for any kind of exemption under section 54 or 54F. So this 1 crore is gone. And on 28th February 23, that is before the due date of filing IT return as well as before the end of the previous year, he deposited 3 crore rupees in capital gain deposit scheme. Okay. On 30th July 2023, that is before the due date of filing IT return. What would be the IT return filing due date? IT return filing due date for him would be either 31st July 23 or would be 31st October 23. Earliest possible date is 31st July 23. On 30th July 23, Mr. A has withdrawn 3 crore from capital gain deposit account scheme and acquired a residential house property worth 2.5 crore. When did he acquire this house property? This he is acquiring on 30th July 23. This would be eligible for exemption under section 54 as well as 54F. What would be the capital gains in the hands of Mr. A for AY 23-24 capital gain if the expenses in connection with transfer of jewelry were rupees 2 lakh? So the 3 crore rupees sale consideration given for jewelry, assuming it is before deducting this 2 lakh rupees of transfer expense. So net sale consideration would be 2 crore 98 lakhs or 298 lakhs, and accordingly LTCG will be only 98 lakhs and not 1 crore. What kind of a question is this? Friends, in this question what they have done is assessee is selling two assets. Residential house property is selling and he is selling jewelry. And he is buying a single asset, he is buying new residential house property. He is buying two residential house properties, of which first one is not eligible. This one is not eligible. Why? We already discussed. Second one is eligible, which is buying on 30th July 23. So the question is, selling one residential house property and buying another residential house property, which makes him eligible to claim exemption under section 54, and selling jewelry and buying residential house property, which makes him eligible to claim exemption under section 54F. Can assessee claim both these exemptions, 54 as well as 54F, both by way of buying one single asset? Answer is yes. We have discussed this in the class along with example. We know pretty well both are eligible. However, for claiming exemption under section 54, the amount which is required to be invested in the new asset should be the amount of LTCG, wherein the amount required to be invested in 54F for claiming exemption under 54F, the amount required to be invested in a new residential house property should be equal to amount of net sale consideration. Therefore, out of these two, 54 is more beneficial as compared to 54F, because here lesser amount is required to be invested as compared to higher amount in 54F. So if both these exemptions can be claimed, then first priority should be given to section 54 and second priority should be given to 54F. However, Section 54F will come up in the picture only if the amount invested in new residential house property is more than the amount of LTCG. Means first we will exhaust section 54 and then only we will move on to 54F. So let's just calculate capital gain. Just check out the details. Building 8 crore minus 6 crore and jewelry 2 crore 98 lakh minus 2 crore. Okay, so we'll be calculating for both these assets individually. First, let's calculate capital gain for residential house property. Sale consideration is 8 crore, index cost of acquisition is 6 crore, LTCG thus would be 2 crore. Under section 54 is buying another house property for 250 lakh, but out of 250 we require only 200 lakhs, 2 crore. Capital gain taxable will be nil. However, associate has invested 250 lakhs but we have used only 200 lakh. There is still excess or balance 50 lakhs left out. That 50 lakh can be used for section 54F. Use for section 54F on sale of jewelry. So jewelry is being sold for 300 lakhs but transfer expenses 2 lakhs and net sale consideration thus will be 298 lakhs. Index cost of acquisition is 200 lakhs, so LTCG will be 98 lakhs. But here, in order to claim exemption under section 54F, the amount required to be invested is not 98 lakhs. Amount required to be invested will be net sale consideration 298 lakhs. Meaning thereby, for the purpose of claiming exemption under section 54F, if the amount invested is 298 lakhs, then the exemption will be 98 lakhs. So if the amount invested is only 50 lakh, then how much will be the exemption? So 54F, 250 lakh is the investment in a new asset, but out of that 200 is already utilized for section 54. Balance available for section 54F is only 50 lakh. But 50 lakh, entire 50 lakh will not be allowed. It will be claimed in this particular proportion. Cross multiplying 50 lakhs into 98 divided by 298 lakhs. Exemption will be, let's calculate it out, 50 lakhs into 98 divided by 298. 16 lakh 44,295. 16 lakhs 44,295. You can also calculate it on calculator. LTCG on jewelry thus chargeable to tax would be 16 lakh 44,295 minus 98 lakh, 81 lakh 55,704.69. Let's round it off to 81,55,705. 81 lakh 55,705, and from building it was nil LTCG. Nil plus 8155 will be 8155,705. What's the answer? What are the options available? Second answer, B point, 8155,705 is the correct answer. Let's just check what's institute's answer. Our answer is B. Institute's answer is also B. With that, this MCQ comes to an end. See you in the next video with the next MCQ.